Hello traders, welcome back to third video in our exciting series. I am Sanjay from Tribe International and I am thrilled to continue this journey with you. Tribe Hub, where financial empowerment begins. This session is powered by Tribe Hub, a place for all financial education, a initiative by Tribe to empower traders with knowledge, tools and community supports to excel in the financial market. Video Part 1. Today we are diving into one of the most important topics in Forex trading: fundamental versus technical analysis. Understanding these two approaches can significantly enhance your trading strategies and improve your market predictions. So let's get started. Let's understand why analysis is crucial for Forex trading. Whether you are a seasoned trader or just starting, knowing how to analyze the market is fundamental to making informed decisions. In Forex trading, analysis can be broadly categorized into two types: fundamental and technical analysis. Both are essential, but they focus on different aspects of market. Fundamental analysis looks at the underlying economic factor that influence a currency's value. It's all about understanding the bigger picture: economic indicators, central bank policies, geopolitical events, interest rates, forex reserve data, and more. The goal is to evaluate the economic health of a country and predict how its currency will perform in the future. On the other hand, technical analysis focuses on historical price data and market trend. It involves using chart patterns and technical indicators to predict future market movement. Technical analyst studies price chart to identify trends, support and resistance level, and various patterns that can signal potential trading opportunities. By analyzing past price movement, traders can make an educated guess, or they can take an calculated risk, you can say that, about the future price behavior, and they can plan their trades accordingly. First of all, we need to understand why any type of analysis is very important for a trader to start out in the forex market. As we have discussed in our first video also, that we need to deal in probabilities while trading in the market, because 100% of the time you cannot be right. Or by taking any random trade, by seeing the market that it is rising, you cannot just buy a particular currency. Or by seeing that the market is falling, you cannot sell that particular currency. That will not gonna make you consistent money. It may be able to make few trades right, but over a period of time, let's say 1 year, 5 year, 10 year down the line, you can't hold up that consistency. So to maintain a consistent result out of trading forex, you need to have a structured approach, or you can say you need to have a probabilistic mindset. And by using any fundamental strategy or any technical strategy, what you are doing is you are creating a set of rules in your strategy that you are going to follow in each and every trade. So here what you are doing is you are following a plan, and when you are approaching the market with set of plan, with a consistent rules, then the market will also offer you some consistent results. Let's say you have created a moving average trading strategy. So that strategy is showing that 65 to 70% is the winning ratio out of 100. So you can say with confirmation that okay, my probability of winning is 70% out of 100 times. But by taking just some random trades, you cannot say that, because you never know. It was always luck. or you can say it was just gambling luck. But when you are taking calculated risk, that is not gambling, that is a structured way to approach the market. So let's dive deeper into fundamental analysis. Fundamental analysis involves evaluating economic indicators, political stability, and geopolitical events to determine the intrinsic value of a currency. There are many economic indicators are there. You can see this calendar here: balance of trade, export year on year, import data year on year. So many type of economic data has been released, or these data shows the position of the country's economy, and if the economic condition is improving, then that will gonna reflect in the currency valuation also. For instance, if a current country's GDP is growing, its currency might appreciate because investors see it as a strong economy. On the other hand, if there is political instability going on, then the currency might depreciate due to increased risk. Why? Because you see, there is a shift in political power is going on. There are some future predictions that this current government will not gonna last much longer, or it will not gonna complete its total term. Then that new government will gonna come and may or may not respect the previous government's policies, okay, or they can focus on different sectors that will may or may not result in the continuous growth of the economy. So these fundamental economic indicators shows you the real position, and by analyzing these different fundamental factors with a structured approach, you can evaluate and make up your investing or trading decisions very carefully. So this is why you have to understand the reasons why and how these certain events, like an increase in unemployment rate, affects a country's economy and monetary policies, which ultimately affects the level of demand for its currency. So we need to understand what are those key economic indicators that you need to focus on, and what are key economic indicators. First of all, economic indicators are statistical data points that reflect the economic health and stability of a country. These indicators are crucial for traders and investors as they influence market sentiment and currency values. So let's look at some economic indicators. The first one is gross domestic product, GDP. GDP shows the total value of goods and services produced within a country over a specific period. Let's say we have GDP growth rate of 6%. Then you can say that the country is rising its economic activity by 6% every year. So year is this specific period, and the value of that 6% is the measure for comparison. Alright, so if the GDP is good enough and it's rising continuously with consistency, then you can say the economic conditions of the country are improving significantly, and the country is going to do well in the near future also, and that will gonna reflect in the currency valuation also. You look at the example of US GDP. The GDP is been rising from the past several decades with a very good consistency. So that has been reflected in the USD INR chart also. This is 84.3820 for USD INR. It means that the US dollar is rising with a very good pace in comparison to the Indian rupee currency, or the Indian economy is been not able to keep the pace with the US economy. So that's why the value of Indian rupee is depreciating and the value of US dollar is increasing in comparison to other countries' valuation. The second factor is inflation rate. This is very important economic indicator that a forex trader needs to keep in mind, that inflation have some major impact on the currency's valuation. So first of all, inflation rates indicate the rate at which general level of price for goods and services is rising. For an example, in the current market, 100 rupee, with the 100 rupees you can buy 1 liter of petrol, okay, and the inflation rate is 8%. Then what will happen next year? With same 100 rupees, you won't be able to buy 1 liter of petrol because the inflation is 8%. So next year, for 1 liter of petrol, you need to pay 108 rupees. So here what happened? The value of this 100 rupee has been reduced because of the inflation, and that is not good for economy. We do not want our currency to lose its purchasing power or lose its valuation. So the impact is moderate inflation. This has been suggested by the economist that moderate inflation we need to maintain to have a healthy economic growth, because too low inflation can disrupt the economic growth, while high inflation can also weakens the country's economic condition plus its currency. You can see here, this is the chart for inflation rates month on month basis, and as of now in October we are at the all-time high. The inflation has been rising up too much. So to control this inflation, central banks or the government needs to take some action so that we have a healthy growth in the upcoming future. So that is why inflation rates you need to always keep in mind, and always use economic calendars to know that when this data is going to release, so that you can plan your trades accordingly. You do not sit on the wrong direction. Alright. Next is employment data. Employment data, it shows the health of the labor market in the country. So there are some several type of employment data has been released by the statistical department in every country. So it includes metrics like unemployment rate, non-farm payrolls, or jobless claims data. Alright, so these all kind of employment data you need to study before you plan your trades. So this is a jobless claim 4 weeks average chart. So this shows that the jobless claims has been reducing bit by bit every month. So this is good, because jobless claim data means that how much people are filing for insurance because they do not have jobs. And we have a forecast pending, means we have been waiting for this jobless claim data for the November month. And if the actual data comes a little bit lower than what we have expected, then it is good for the economic condition, and it will gonna reflect in the currency also. So that is why you need to check these kind of datas before you plan your trades. What will be the impact? Strong employment data often leads to currency appreciation. Means if the employment rate is getting higher and higher, then it's good indication that people are getting job and they are earning, so they will spend in the market also, and that spending and earning will gonna boost the economic activity, and that will gonna increase the value for the currency also. The major and the directly impacted economic indicator is interest rate. Interest rate have a direct impact on the currency's valuation and the growth of the economy, because interest rate provides very importance for investment purpose and borrowings also. So let's see, central bank periodically publishes their decision on the interest rates. They keep tweaking the interest rate. Sometimes they increase it, sometimes they decrease it. Why they do that? Because to maintain a good stability in the economy. Interest rate is a tool to control inflation and stimulate growth in the economy. Higher interest rate will gonna attract good foreign investment, because if let's say we are offering 12% interest rate, so everyone in the world will try to invest in India because we are giving fixed and secured return which is higher than the other countries. So definitely we will gonna receive good investment, but that will also gonna reduce borrowing. A higher interest rate means we are discouraging new businessmen or new industrialists to take loans and start new manufacturing units or to boost up their business activity. So interest rate needs to be maintained or needs to be balanced between both of the sides, for the investment purpose also and for borrowing purpose also. So you need to keep track of these interest rate data points while they are releasing, so that you can capture some good moves in the right direction. This is last 10 years of data on interest rate. As you can see, the RBI has reduced in the initial period till the COVID time, and then after that they have slightly increased it, and now they have keeping a constant stance for the interest rate from last 1 year, and now we are again in talks for reduction in interest rate to maintain the stability in the economy. Trade balances is nothing but the import and export data. It is a difference between countries' exports and import. How much you have exported and how much you have imported. If you have exported more than what you have imported, then you are in a good condition. You are increasing the value of your country's currency. But if the trade balance is a little bit off, let's say our imports are very high and our exports are very low, then it will gonna have negative impact, because if the imports are low, then the outflow of our country's currency is high, and that will gonna reduce the purchasing power. Alright, so let's see the impact. A trade surplus. Surplus means the exports are higher than imports. That usually strengthens the country's currency, while a trade deficit means we are short, means our imports are very high, that can weaken it. So this is just a simple formula: total export minus total import, and you will get the balance of trade data. This also got published periodically, so keep track of these with the help of economic calendars. Now let's talk about political and geopolitical events impact the forex market. Political event like elections, change in the government, or continuation of the previous government, and geopolitical events like escalation of any wars or any trade concerns like this. So these have a very strong impact on the currency market. Political stability and economic performance. Political stability refers to consistency and predictability of government's policies and action over time. Means that we have made a goal for boost in education and healthcare for a period of 15 years, but the government changes every 5 years. Then what will happen? That if in the initial 5 year, in the first term, one government have focused on the agenda of education and healthcare, but after 5 years the government has been changed, the power has been shifted, may or may not focus on that particular agenda set by the previous government. So now the goal has been disrupted and the work will gonna get impact, will gonna reduce the efficiency of the resources, right? So that is why we need a very good political stability for the currency and the country to risen up. Stable political environment generally leads to stronger economic performance and more stable currency. Otherwise, if there is a fear of change in government overnight, then the currency will gonna fluctuate too much. The volatility will be too high. These are the factors that can get affected with the political stability, which is investment, policy continuity, consumer and business confidence. If the fluctuation is too much in the political environment of a particular country, then foreign investors might get discouraged and do not invest here. And if they feel that the policy continuity is not there, then any big projects or big industries will not gonna set up in that particular country, or the consumers or the businesses will not gonna give too much investment in the particular country, or they will not get encouraged to set up more facilities. So that is why we need to have political stability and you need to keep track of it. Geopolitical tensions such as conflicts between two countries, trade wars can cause significant market volatility. These events can affect investor sentiment and lead to rapid currency movement. So that is why you need to have a good understanding on what is happening in the world. You need to keep track of the news around the country's pair you are trading, so that you not get trapped in the wrong direction of a particular trade. Economic calendars. One of the best tool for fundamental analysis is economic calendar, as economic calendar tracks key economic events and data releases, providing traders with crucial information to plan their trades. On TradingView, you can find economic calendar with the whole worlds of economic events, their timings and their forecast also. So you can plan your trades with the help of these economic calendars, or you can just search on Google also for economic calendar and you can use any one you will find. Okay, so you can use these economic calendars for research purpose. It is important to know what's going on within the financial markets and sectors where you have positions. In the calendar, you can compare the actual and the historical data and see the divergence from the forecast to better understand trends. All this can help you design more event-driven strategies, and that will gonna help you avoid trading when the market is getting too much volatile by positive and negative newses. Alright, so this is how you can use the whole economic calendar around your forex trading. That's all in the video part 1. Till now we have discussed about some fundamental analysis and factors that influence the fundamental movement of a currency. Now in video part 2 we are going to discuss what is technical analysis and what are its indicators. By using them you can analyze the price of the particular currency. So let's get started. Technical analysis is the study of historical price movement. We have discussed that in our earlier video also. So we are going to touch the basics first, then we will move forward to the indicators section. What is technical analysis? Technical analysis is a research technique to identify trading opportunities in the market through the study of historical price movement on the chart. We are studying past price movement which has already occurred by studying those price movements, we can analyze and make some trading decision that okay, this pattern has done this thing in the past, so now in the future also if similar pattern forms, then it will have a probabilistic outcome which is very much similar to the past. So over time, patterns are formed within charts and each pattern conveys a message. That message is what mass traders are thinking and doing. So all of the buying and selling activity from different players collectively reflect on the price chart. And if you know how to study that particular price chart correctly, then it will become very easy for you to understand what is happening right now and what can happen in the upcoming future. So as a technical analyst trader, our job is to identify these repetitive patterns and forecast trading opportunities based on it. So technical analysis is more than art than science because it is very subjective in nature. What I am interpreting of by looking one chart can be different from what you will gonna interpret. So that is why if I am having a buy opinion, then on this similar chart you might have a sell opinion also. So it is very subjective and it depends on the techniques that you are employing on the particular chart. So that is why you need to be very careful and find as much as confluence you can before you initiate a trade, so that your probability of winning will get a little bit higher. You will have a little bit edge in the market. How technical analysis helps traders in taking short-term decisions. So by analyzing these charts and technical indicators, traders can identify trends, spot trading opportunities, and make more informed decision. In fundamental analysis, we have seen some key economic indicators which study the economic condition, but in technical indicators, they are a bit different from the economic ones. In technical analysis, indicators are mathematical calculations based on historical price, volume, or open interest data that traders uses to predict future price movement. So here are some most commonly used technical indicators. But those technical indicators are divided into two sections. The first one is leading indicator and second one is lagging indicators. Let's take a minute and understand what is leading and what is lagging. Leading indicator means which moves ahead of the price movement, means which can have a predictability feature, and lagging indicators are which indicators they follow the price. They are moving behind the price, means whatever they are signaling now, that is a little bit late. But leading indicators move ahead of the price. For example, moving averages are lagging indicator. Moving average gives their value after the price has done certain movement. But leading indicators like RSI, MACD, they leads the price. Okay, they will show you a little bit before what the movement can occur in the upcoming future. So first of all, let's discuss moving averages because it is most commonly used and most frequently used indicator in the technical analysis, and it will helps you identify trends, identify ranges, or it have also properties that can show you support and resistance areas, major reversal areas. So let's look at moving averages. Moving average is a technical indicator that averages the price movement over a period of time. Let's see. The initial day the price is 54. Now on the second day the price is 58. Then on the next day 59, 55, 60. So these are some price movement for the 5 days. So what we have to do is, to find an average, you have to calculate the total value, means 54 plus 58 plus 59 plus 55 plus 60. So now the total amounts to 286. Now we have to divide it by 5 because we have 5 data points in this data series. The average price will come out to be 57.2. So we can say that the average price for the last 5 days is 57.2. So this is an average price. The current market price as of now is 60, but the average price is 57. So this has cleared out the extreme value in the data set, and if you want to buy, then it is very good that you buy around this zone because it is a balanced point where buyers and sellers are agreeing. Alright, so this is 5-day period. Similarly, you can employ many different values of moving averages like 200 moving average, 50 moving average, 20 moving average. Let's understand it in detail. The indicator described as moving. Why it is moving? Because you see, we are using 5-day moving average, let's say, then 54, 55, 59, 57 and 60. Alright, so these are 5 days. Now on the next day, if the price reaches to 62, then what will happen? This data point will get included into this data series and the last data point will be removed from this calculation. So now we will calculate the average price on the next 5 days of price. So this is why it's moving in nature. When the next day the price will added, let's say 64, then this price will get eliminated and we will continue the last 5 values each and every day. So this is why the moving average is moving in nature. It's moving ahead and eliminating or removing the last data point. Alright, so it replaces the old data points and move the line on the chart. Moving average can be used to identify support and resistance areas, and moving average is a trend following indicator. Remember this, do not use moving averages in a range bound market, because in range bound market moving averages only signals a zigzag movement and they often give you failed signals there. So moving average is not a range bound trading indicator. Do not use it while the market is in range. It's a trend following indicator and it gives wonderful trading opportunities in a trending market. So see how moving averages look like on the chart. This is a USD CAD 15-minute chart. You can see this blue line is 200 EMA, means 200 day moving average. It is calculating the last 200 candles movement and showing you the average price. And then this green color line is 50-day moving average. This red color line is showing you 20-day EMA, and then this tight black color line is 5-day moving average. Or I am using day here because it is most frequently used. Otherwise, this 200 means 200 candles on 15-minute chart. If you just change the time frame to 1 day, then it will calculate last 200 days calculation. Alright, so moving average will automatically shift their time frame according to what time frame you are using. If you have set an input for 15 period, then it will gonna calculate last 15 candles. Alright, so you can see how it is giving wonderful signals As you can see, it was in a very tight range here, or it's forming some kind of triangle formation, and then on the break of this range and break of the EMA support, all of the EMAs are forming or acting as a support area here. But when those support area or EMAs got broken down, it has given a wonderful fall to the downside. Similarly, it is forming again a good range here like this. It will test the 200 EMA, and then if the downtrend wants to continue more, then it will get rejected from this level again. So this is how you can find out some good support and resistance areas with the help of moving averages also, and it will gonna show you the trend also. As of now, we are trading below 200 EMA, so we are in a downtrend. Earlier, when we were trading above the 200 EMA line, then you can say that the market is in uptrend. So it's a trend showing indicator also. Now the next type of indicator is relative strength index, RSI. It's some kind of leading indicator. It shows you how much momentum or how much speed is there in a particular trend or in a move. RSI is considered a momentum indicator, which means that it is used to determine the speed and strength of price movement and whether the underlying momentum is increasing or decreasing. You can know it with the help of RSI indicator. RSI is not a overlay indicator, as we have seen that EMAs are overlay. Overlay means it is formed on the chart itself in combination with the price. But RSI is a oscillator, means it is a window oscillator. It oscillates at the bottom of the chart like this. It is plotted in a window. The price movement will gonna be here like this, and at the bottom of the chart the RSI will gonna plot here, and it oscillates between 0 to 100. Oscillation means back and forth, back and forth. So the values are for this indicator is 100 and 0. It cannot go to 101, or it cannot go below 0 level. It cannot go into minus levels. Alright, so it has a fixed set of value that it can move in, and in this 0 to 100 we have divided some more zones. Like this is 70 zone, and a little bit below here this will be 30 zone. So whenever the price is trading above 70, we will call it the overbought zone. This zone is overbought, means the price momentum has reached its end and it can reverse from there. This is what the overbought zone signals, and oversold zone is here. When the price reaches below or around the 30 zone, then you can say the price has been sold off enough and it can reverse up from the below. So this is how this indicator is plotted on the charts. We will see it in detail example. So you can change this 70% and 30% zones, overbought and oversold zones, according to your trading strategy. As I use 75 and 25 as my oversold and overbought levels, because it suits my personality. Now you have to determine what suits you. Alright, so this is what the indicator looks like. This is by default set it to 15 period. Alright, now you can see when the price has fall down, it has reaches below the 30 level, oversold, and now it is moving up as the price is, and it also has given a fall signal a little bit around this zone, so that the price has declined from here. Again you can see this level also, the RSI reached up to this zone, and the price is also trending higher. From there it has given a small correction to the downside. So you have to see some other price action factors also. Never use RSI or any indicator by just its own. Use these indicators in conjunction with the price action also. And I would say whatever confirmations you can find, you should find it and take an edge in your direction. So there are some limitations. As I said in the moving average section, that it should not be used in range bound market. Similarly, RSI should not be used in the trending market. So these both indicators are opposite of each other. Moving average is a friend of trend, but RSI is friend of range bound market. Remember that. Whenever moving averages is not showing you good movement or not signaling you enough good trades, then you might want to rethink and evaluate that the market is in uptrend, downtrend, or in a range bound. If it is in range bound, then you should go with the RSI. Range bound market and RSI works pretty well. Okay, so if the indicator display momentum, it can stay overbought or oversold for a long time when an asset has significant momentum in either direction. Let's say the market is moving up and up and up and up and again. Okay, so the RSI can stay in this upper range for too long period also. So this is why in trending markets, do not use RSI. RSI alone can generate false signals, and every other indicator also can generate false signals alone. So always use in conjunction with the price action. Okay. Similarly, MACD is a leading indicator which can show you signals ahead of the price movement a little bit. MACD is the difference between two moving averages that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26 period EMA from 12 period EMA. I'll show you it on the chart. MACD is all about convergence and divergence of two moving averages. Convergence occurs when two moving averages move towards each other, and divergence occur when two moving averages moves away from each other. Alright. The technical indicator is tool that used to identify moving averages that are indicating a new trend, whether it is a bullish or it can be bearish. So MACD is helpful in trending markets. It does not work well in the range bound market. So let's see. This is British pound versus US dollar on day chart. You can see it has started a new trend here. So a crossover has occurred. Okay, from the below zone, the histogram has formed up on the upside line. So let me show you the properties of this moving average for this tool first. So this is MACD line. You can just remember this. It have a blue line, a orange line, and these histograms forming in middle of this tool. So here MACD line is the difference or distance between two moving averages. As I said, MACD is plotted with the calculation of two moving averages, and it plots the difference between these two moving averages. So the MACD line is the difference of these two inputs, and MS and this orange line is signal line. Signal line is the moving average of this MACD line to smooth out the erratic or noisy price movement. Okay, it reduces the noise. So here by default the MACD's indicator uses 9 period as a signal, and histogram is nothing but the graphical representation of the distance between the MACD line and the signal line. See this on this chart. These histograms are forming similar to the distance between the MACD line and the signal line. So this is what it is forming here, and how it signals you buy or sell. You see these crossovers. The red histograms are reducing in size and forming smaller histograms subsequently, and then when the crossover occurred, the MACD line moved above the signal line, and at the same time the histogram also started forming above the zero line. So this is the zero line. Below this is minus value and above this will be the plus value. So the histograms have also formed up on the upper side. So it has generated a buy signal here. It moved up, it has reached up, and from this price point the histogram started to reduce a bit. So here is your target or a short sell signal. You should use trends and other price action criteria before taking any trade, but here you got early signal that this trend is not gonna last long or it will form a retracement. It has formed a retracement. The price hit this zero line and again resumed its uptrend, and the MACD also have given a crossover here, so you can buy here. Alright, and at some point of time the histogram started to reduce its movement and its size, so you have a retracement. So this is how the MACD indicator works. Now we have discussed some basics of these indicators, and we will create separate videos in each and every indicator so that you will have a very detailed knowledge about these indicators. I hope you got a brief idea that how these indicators work in the technical analysis. Which indicator video you need, first just comment down and we'll make it for you. So the best approach will be combining fundamental analysis with technical analysis. Using both of these together can give you a comprehensive view of the market to make better informed decision. Benefits of combining are that the fundamental analysis provides the why behind the market movement, while technical analysis offers the when to enter or exit trades factor. Together they offer a balanced strategy. For example, you might use fundamental analysis to understand the impact of central bank's interest rate decision on a currency pair, and technical analysis to find the best entry and exit points based on the chart patterns and indicators. Alright, so that's all for today's video. Make sure that you subscribe to our community channels to stay updated about upcoming videos. Thank you for sticking around. If you found this video helpful, there are plenty more to come in our series on Forex and technical analysis. Don't forget, for all your trading needs, visit tribe.com. For more in-depth trading education, head over to tribehub.com. Thanks for watching, happy trading, and I'll see you in the next video.